Washington was open and back to business today, and Wall Street celebrated big time. The S&P 500 closed at a new all-time high. The Nasdaq is now sitting at a fresh 13-year high. And there were more milestones. The Dow Transports, the small-cap Russell 2000, and the S&P 400 mid-cap indexes all ending at record closes. With the budget and debt ceiling deals wrapped up, investors focused on fundamentals. A rush of corporate earnings, some better than others, along with stronger than expected manufacturing data from the Philadelphia Federal Reserve Bank. We'll have more on those earnings in just a few minutes. But first, here are the closing numbers. The Dow was the only index in the red. It lost 2 points, dragged down by disappointing earnings from three components: IBM, United Healthcare, and Goldman Sachs. The Nasdaq rose 23. The S&P added 11 points to 1733. That's its new record close.
And so was yesterday's deal in Washington an all clear for the markets or something far, far less? Joining us now to discuss the way forward for investors like you is Nick Colas. He's chief market strategist at ConvergEx. You know, Nick, I've been calling this the sort of resolution rally that we've been in for the most part over the past week and continuing to today, when you had 23 of the 30 Dow components actually higher, and those three that Susie just mentioned, the reason why it was down. So do you think this resolution rally can continue? Do you think the markets are going to end the year higher than they are today? And if so, why or why not?
Yes, absolutely. And you're right to call it a resolution rally. It was a very nice liftoff after we got the good news yesterday. What's even more remarkable, though, is that stocks really didn't sell off very much during all the turmoil in Washington. They accurately forecast that we were going to get a resolution, and this rally today is really a follow-through. Looking forward, I'm very optimistic about stocks for the balance of the year. We do have several things in our favor. Corporate earnings are still quite strong, even though revenue growth isn't really where we want it to be yet. And at the same time, we still have very low interest rates, and we have hopefully a recovering consumer and economy now that this turmoil has passed.
But you know, Nick, you mentioned about earnings. A number of analysts are saying that for this upcoming current quarter, there are going to be a lot of blame put on this government shutdown. So what's the spillover effect going into 2014, and what does this mean for stocks?
Yeah, there's a very interesting intersection going forward as we look into January, when the next version of the current crisis is going to play over again. The critical junction is going to be Christmas and holiday season in 2013. The consumer was a bit shaken by what happened in Washington, and confidence fell. Now we need to see a resurgence of consumer confidence going into holiday season. That's really the make or break issue for the markets going into the first quarter of next year.
Yeah, I heard someone today describe the market this year as basically a Teflon market. Nothing seems to derail it. What could?
What is really the critical junction here is that even though earnings have been quite strong, we're going to see record earnings on the S&P to match these record levels that we saw today as we see the third quarter reported. However, the revenue growth has been quite sluggish, really flat over the last 4 quarters, no better than 1 or 2%. To really get markets enthusiastic about 2014, we need to see revenue growth begin to pick up, and that's really 100% on the come. It's been a real faith trade so far. We're going to have to see that faith translate into actual numbers come Q4.
So, Nick, you mentioned that we're going to be back into this crisis mode in a few more months. So what should investors do? Do they need like a two-phase investment strategy, pre-crisis investing and then post-crisis investing over the next 6 months?
You know, investors are still, as I talk to institutional clients of ConvergEx, still very scarred by the events of 2007 and 2008. No one is really taking as much risk as they did 4 or 5 or 6 years ago. And that to some degree is healthy. It allows us to live through this turmoil because investors aren't as much over their skis as they used to be. So as long as you maintain a reasonably diversified portfolio and don't invest too aggressively, you can live through these little mini crises. We saw that happen just in the past couple of weeks when investors continue to put money to work. We should still see that again in Q1 because now we kind of know the playbook.
Let's say I want to put a little bit of money at work. I got some cash on the sidelines. What 2 sectors in the U.S. market would you favor over, let's say, the next 3 to 5 months?
Yes, the 2 sectors we really like the most. One, financials. Financials have been a real leadership group. These are banks and credit card companies, organizations that lend to consumers. Those should continue to do better as the economy improves and interest rates stay low. The second group, which is a little more controversial, is consumer stocks. We talked about how consumers have been a little shaken by what's happened. Holiday season should now have very low expectations that consumer stocks can begin to beat.
All right, Nick, thank you very much. Appreciate you being with us. Nick Colas, Chief Market Strategist at ConvergEx.